You were not meant to be a slave to the grind. You were not meant to trade your life force for money. You can escape gravity. You can unlock your life. You got this. Let's go.
Hello and welcome to Unlock Your Life. I'm your host, Jennings Smith. Excited to be here today. It's me and you, and we're talking about something that you cannot do with single family rentals. And this changes everything. So if you're able to do this, which you are able to do with a certain classes of assets, it can completely change the game. So let's dig right into it. I'm going to start with a story. I bought a 3-bedroom, 2-bath house in Somerville, South Carolina. Address was 509 Corey Boulevard. You can look it up if you want. I bought it in, 2014 or 15 for $115,000. And I put down 25 grand, got a loan on it, and I rented it out for $1,100 or $1,200 a month. And I held that property for about 5 years. So over the time, I pushed rents to $1,250, $1,300 as the market improved. And I live in a place called Somerville, South Carolina. It's right outside of Charleston. And so the Charleston, South Carolina market has really grown, and Somerville has really grown. When my dad was a kid, there was about 3,000 people here. When I was a kid, there was 30,000. Now there's 100,000 in Greater Somerville. It's definitely a growing market. And because of that, the real estate market is growing. And so over time, my property values are going up and the rents are not really going up as much as the property values. And I'm looking at this house and it's worth $240,000 5 years later. All right, so bought it for $115,000. It's worth $240,000 now. I'm renting it for $1,400 a month, maybe at this point. And I'm just looking at the amount of equity I have tied in there. And I think now my mortgage was down to 70 grand. And I decided to sell it. Right, so I sold it, turned a great profit. And you're like, well, Jennings, cool. Who cares? Cool story. Well, the point I'm trying to make is that was not smart, right? That was not me being smart. Now, I'm not saying it wasn't smart to sell it or to not sell it, or should I have held it, which is probably what you're thinking. What I'm saying is the reason I sold it for a profit was because I got lucky. I sold it for a profit because the market did well. Did I know the market was going to do well? I mean, I don't know. I knew Somerville was a decent town. I could not have predicted the growth that we had, right? A lot of growth over 5 years. And so I would love to sit here and say, yeah, I did all this market research and analysis and I knew that the market was going to go up and I knew this property was going to more than double in value in 5 years. And I was going to look like a very, very, very smart real estate investor when I sold it 5 years later and turned a nice profit. But it's not true, right? I got lucky because I want you to ask the question, why was this property worth $240,000? It sure wasn't worth that because of the rents, right? The rents barely covered the mortgage, the taxes, the insurance, the maintenance. Like, it was not a huge cash flowing deal. And I'll tell you, whoever bought it at the $240,000 price, they definitely weren't going to be able to use it as a rental. They were using it. I think they were just going to live in it. It was going to be their single family home because now they've got a much larger mortgage. Property taxes were going up in Dorchester County. And then, it needed a new roof. I think I replaced the roof right before I sold it, but air conditioners go out, there's maintenance, et cetera, et cetera. And so you wouldn't look at this as an investor and be like, oh yeah, I'm going to pay $240,000 for this house because that's a great investment. You may look at it as an individual and say, well, I'd like to live in this neighborhood. I'd like to live in Somerville. That's a decent town, so it's worth $240,000. And the point I'm trying to make is the only reason why that house was worth $240,000 is because all the other houses in that neighborhood were worth that or similar to that, right? Per square foot. That's what the going rate for single family homes in my town 3 years ago were going for. And if I'd held it, I probably could have sold it for more if I'd held it for 2021 or 2022, but that's beside the point. The point is the neighborhood dictated the value of the home. All right, so let's play out a scenario in another area, right? There are rental homes in a town like, let's just pick a town, Hartsville, South Carolina. It's a small town, kind of in the middle of nowhere, and not a whole lot of growth, right? Their population is flat. And so maybe you bought a house 10 years ago there for $50,000, and maybe 10 years later, it's worth $100,000 or $150,000. It's still gone up in value, but not that same jump, just because it's not as hot of a market. There's not as many people moving to that area. It's not as desirable. And the homes in that area are not going for as much per square foot, right? I was a builder. I was very, very cognizant of when someone wanted to build a custom home, it didn't matter what market they wanted to build it in. To me, it was going to cost the same amount, right? If I built it in Somerville, or I built it in Mount Pleasant, or I built it on the islands, it was pretty much going to cost what it cost to build. And yet the valuation of that home was drastically different based on the location. Okay. So now we're going to switch into multifamily, commercial real estate. And this goes across all commercial real estate classes. When I say that, I mean like self-storage, I mean mobile home parks, I mean apartment complexes, I mean hotels, I mean, triple net lease stuff, strip malls, grocery stores, retail, etc. So those properties are an investment, right? There's nobody that's going to buy an apartment complex and be like, this is my dream home. I'm going to live here. I don't really care if it ever makes money. I don't really care if it's ever worth anything or never generates cash flow. I just really love this apartment complex. I really, really love this strip mall. Nobody's buying stuff with that motivation. And so the pricing is dictated pretty much by what profit does this property make. Okay. The market definitely plays into it, right? Because if it's in Miami, it's a hot market. Miami is going to have higher prices, but in commercial, it's going to have higher prices, most likely because you can command higher rents for those apartment complexes. You can command a higher per square foot lease rent on your grocery store anchor because it's in Miami and there's lots and lots and lots of people there, right? So there's more demand. So I want to take this example back to my own personal story. So we've got a 12 unit, which you probably heard me talk about. And I bought this in a small town of 5,000 people, Williamston, North Carolina, for $250,000. And I bought this. It was really losing money. That's why I got a great price, because it would have cost more than that to rebuild this property, but it wasn't profitable. It wasn't making money. And so the owner was motivated to get rid of it. I went in there and I lowered the expenses some. I got rid of the trash. I instituted a water utility bill back for $85 a month or $75 a month. And I raised rents, I think $20 a month. So I didn't raise rents that much, but I did add a utility fee. And in doing so, I was able to increase the profitability of the property, right? By lowering the expenses some, I got a new management company, and I also raised rents into the utility bill back. And so I took the valuation of this property from $240,000 to $415,000, which is what I sold it for 18 months later. And if you look at the market data on Williamston, North Carolina, it did not increase, right? The property values didn't really go up in those 18 months. The population didn't swell. Boeing didn't come and build a plant in the middle of Williamston, North Carolina to make everything more valuable. None of that. What happened was we increased the function of how much profit does this property make. And the point of this podcast, the point of this episode is you can identify value adds, right? You can identify properties where you can make that property more profitable. And if you do so, you'll be able to sell it for more, right? And so how do you calculate that? How do you know that? Because we know it's a function of math. And how do we do that? How much money can we make doing that? Well, I'll get into that, but let me tell you a second example. This is a deal that I just bought, I don't know, last summer, maybe 6-8 months ago. 34 unit in Barberton, Ohio. We bought it for $1.2 million. So about $40,000 a door. It needed very little renovation. It already had new roofs. It had new parking lots. It was freshly painted, vinyl siding on 3 sides. The fronts were all painted. It was full, and the rents were like $500 to $600, and the market rents were $750 to $800. Okay. So what we did was we went in and we raised rents to market. We went up about $150, $200, and some people left. We fixed up the units. We released them. Some people signed the renewals and they stayed there. But in increasing the profitability of this property, the value went from 1.2 million to 2.3 million, right? And we're not quite 100% done. We got about maybe 4 or 5 more months to get the rent roll fully where it's going to be. But you see my point, right? Because if we can add $200, write this down, $200 times 34 units, right? That's $6,800 a month. Now, there's going to be some expenses associated with that, some property management fees, and maybe some additional whatever. But it's just a rent bump, right? We're already covering the majority of our expenses through the base rent. So a lot of that is going to be profit. So let's just say we got to pay the manager $600, $700 off of the top of that. And let's just say we're netting $5,000 out of that $6,800 rent bump. Okay, so $5,000 times 12 months. And I'm lowering it too because you got to think about vacancy and some other stuff. 12 months, that's $60,000 that we've added to the bottom line, right? So if you were to sell your property at a 10 cap, right, which would be a phenomenal price. A 10 cap would be super cheap to sell an apartment at. That is like $600,000 in value added to that property at a 10 cap, right? At a 5 cap, it's $1.2 million in value added. Now, Barberton, Ohio, probably not a 5 cap. It's probably more like a 7 cap. So let's just say $60,000 divided by 0.07, right? 7%, 7 cap, $857,000 in increased valuation on that property just by bumping rents. Okay, so did Barberton, Ohio swell in population? No. Did Barberton, Ohio get a massive manufacturing boom? No. Barberton, Ohio was already at $800 a month market rent. So that's where everyone else already was. And this owner, for whatever reason, wasn't. This owner didn't want to do that. They didn't want to retenant it. They didn't want to fool with it. They just wanted to sell it. And that was fine, right? And so we walked in, we're able to add, $800, $900, $1 million in value, depending on where we go with that property and how long we hold it and how much debt we pay down. And the point is we can control that. We can control the market to some extent. Now, I can't control the interest rates, and that affects valuation as well. And I can't control a declining market, right, where population is leaving, which also can hurt your valuation. Right, you still need to buy in good areas. Location is still important. But you have a lot more control over the value of your property than you do in single family homes. And there's also a lot of deals that have opportunity, right? So in single family homes, if the house is vacant, right, it's a rental home and it's vacant, who cares? It's still worth $200,000, right? Whereas if an apartment complex is vacant, that is a big problem because that thing is not making money. In fact, it's losing money because you still have to pay the taxes, the insurance, the water, the mortgage, et cetera, et cetera. And it's really, really bad if an apartment complex is vacant. So you can get a really, really good deal. Or even if it's just 20%, 30% vacant, you get a discount because that's a value add property. And now you fill it back up to 100%. And when you have 70% occupancy, you probably have some people not paying. You get rid of them. You tighten that thing up. Do some renovations, get your collections up, and all of a sudden, you've added 30% or more to the bottom line of what this property was doing. And so you can vastly increase the property by buying some of these properties that have an issue, right? Are they easy? No. Is it simple to get them filled up? Not necessarily. It's work and it's risk, but you are making that property better. You're making it more profitable. And when you go to sell it to the next investor, he or she is looking at that thing and it's tuned up. It's full. There's very little delinquency. There's very little vacancy. You've maintained and fixed everything that's been broken, and they can walk into a pretty simple cash flowing deal. Are they going to pay a premium for it? Yeah, they're going to pay a premium because there is very little risk. But that's where you can make the money and you can control your destiny. Okay. Next real life world example, 208 unit in Oklahoma we bought, 50% vacant with another 10 or 20% not paying. Really, really bad property as far as the condition. Slabs cut open. I mean, there was, I think, 32 units that were really like hard down, like gutted almost. So we needed to dump $2.5 million into renovating this thing, carrying the cost of the debt, because even though a property is distressed, it's still not worth nothing, right? The buildings are still there and there's still potential there. And sometimes you got to pay for the potential. So this dude was collecting $55,000 a month when we took it over from him, and we scratched and clawed and did the renovations and fixed up the exteriors and fixed up the interiors. And we slowly clawed away at that occupancy, and we got it up to 60% and 65% and 70% and 80%. And now we're at 99% occupancy. We're collecting $130,000 a month, right? From $55,000 a month. So you think that property is worth more? Absolutely, 100%. And we were able to control that, right? We knew that we could force the valuation of that. And that was our business plan, right? So we bought that for $5.5 million, put $2.5 million into it. And we knew that we could go get a loan when we were done and pull that money back out, right? Give it back to the investors, pay off our first loan, get a new loan, and then we can go on to the next deal, right? And so 2 years later, that property appraised for $13.9 million. And the bank agreed to give us a loan of $9.5 million, non-recourse, Fannie Mae, 3 years of interest only, 7 years of fixed at 4.25%, or 10 years fixed 4.25%. And we're locked in. We're good. We don't have to worry about that property for 10 years. And it's cash flowing $20,000 to $30,000 a month after paying our $9.5 million loan. Right. And remember, we only had $8 million in it to begin with. So we have a bunch of money left that we distributed to the investors, some of it, and some of it we set aside for repairs and escrows so that it doesn't turn into a headache for us. Right. We always have cash on hand. So that is another example. Like, you can't do that with a rental home. You can't raise rents across your portfolio by $20. You know, think about that. $20 across a portfolio of 1,000 units, right? That's $20,000 a month. So $20,000 a month times 12 is $240,000 to the bottom line. Let's just say there's some slippage, there's some breakage. Let's just call it $200K to the bottom line. $200K to the bottom line at a 7 cap, right? Let's do the math on that. If your property portfolio averaging a 7 cap, $200,000 divided by 0.07, $2.857 million. You just increased the value of your portfolio by raising rents $20. Okay? So do you think inflation is going to continue to happen? Do you think that rents are going to continue to go up? Absolutely. And every time they do, it's now helping you. It's putting you in a better position, right? So think about this as you're building your portfolio. If you're listening to me and you already have a rental home portfolio, right? You've got some single family homes. That's awesome. That's great. I would never tell you don't buy a deal, especially when you're first getting started. But, you know, after you get 5 or 10 or 20 or 30 of these, do the math, right? Do the math on how much time and effort this is taking you. How much money are you actually going to make at the end of the day? How easily can you scale this? And is this the direction? Is this the best direction that you should go in? Or should you click it over a couple degrees and start pushing towards commercial real estate, multifamily, self-storage, apartments, mobile home parks, whatever? Because those are properties that you can control your own destiny, right? Where you can make the valuation what you want it to be. You can't do that in single family homes. So if you want to, generate a couple $1 million in net worth at the end of your life, get out there and buy some single family homes. If you want $50, $100 million net worth, you want a large portfolio that is, you're playing in bigger numbers, then you need to to reach out to me, right? You need to message me, and you need to think about making the leap into bigger deals. And I know that's probably uncomfortable. I know that's probably a little bit scary. You may be thinking, well, I don't know how to underwrite these deals. I don't know how to analyze these deals. Well, these deals are hard to find. These deals they're just, everything I see online doesn't make any sense. And not to mention, I can't get a loan. I can't get a $5 million loan. I can't put a $2 million down payment down or $1 million down payment down. I can barely scrape together 50 grand or 100 grand to buy my next rental home, right? I get that, but there are answers to all of that. And think about how difficult and impossible it may have seemed to buy rental homes when you first started. And after you figured out how to do it, maybe you figured out private money, maybe you figured out hard money lenders, maybe you have investors, maybe you're doing seller financing, seller carryback, right? And once you kind of understood these concepts, all of a sudden you realize, okay, so it's not that hard. I just didn't know how to do it, right? And maybe you could look at the same thing here, right? Where it's like, yeah, there's stuff you don't know about multifamily. There's definitely some differences in how to analyze commercial real estate. But if you are a proven winner, if you can close deals, if you already have a portfolio, you can do this. This is not any harder. It's just a little different. And with the right information, with the right team, with the right network, you can get clicked over just a couple of degrees and you will succeed at this too, because you already succeed at what you do. Now remember, I'm talking to the people that already have a portfolio, right? There's a large demographic out there that do not have the risk tolerance to do their own thing. They don't have the risk tolerance to go out there and start a business or take down a deal or grab the bear, wrestle it to the ground and cut his throat. They just don't, and they never will. I'm not talking to them. I'm talking to the people that already have got it going on, but they maybe are not working on the best asset class. They're maybe not leveraging their time and efforts in the best way. Because let me tell you, there is deals out there. There are deals out there. There is money that wants to be placed in deals. There are apartment complex people that want to do seller financing, that want to do creative financing, that want to do seller carryback. There are people with net worths of millions and millions of dollars that want to sign on loans and partner with you to close deals if you find a great deal. There are people that want to invest with you. They'd love to jump into real estate, but they don't want to deal with rental homes, right? So they'd love to jump in a bigger deal where you're handling the headaches and they're just placing the cash, right? When you start thinking beyond these problems and these limiting beliefs, you start to unlock the possibility. And then you start to think, man, what if I did know this stuff? What if in a year or so, I mastered this and I'd closed a deal or two? I remember when I first started closing single family, it got a lot easier, right? Maybe this will get a lot easier. What if I did partner with people that could bring down payments? What if I did learn how to raise capital? What if I did get people involved with my deals? Holy cow, I could scale, right? I could buy real estate as long as I can buy safe deals that make sense and are going to protect and grow my investors' capital. What's holding me back? If I can do this with hard money lenders and I can do this with single family, why can't I do this with multifamily? So if that's you, then shoot me a message. Shoot me a message on Facebook, Instagram, whatever, and we'll connect. We'll talk. I'll hear out where you're at. And if I'm certain that I can help you, then we can talk about the deal room. It's my mentoring program. It's $400 a month, and it's a phenomenal value for moving people from single family to multifamily. But we're very clear on who we're going to work with, right? And that is people that already have an established portfolio. They're already in real estate. They already are entrepreneurs. They know what they're doing, and we can just shift them over and make them be successful in this arena. All right, guys, so that's what I got for you today. Appreciate you. And if I can help you, reach out to me. Don't forget to take some time this week to unlock your life. Peace.
This is the podcastfactory.com.